Well, thank you, Mark, and thank you, Jeff, and my thanks to Gina for all her help getting me set up on this. I appreciate the opportunity to speak again to Ppfa. My name is indeed Hazel Cruz. My position at IHS, I am the Vice President of Inorganics. So there are a number of our businesses that are within Global Inorganics. One of them is the vinyls business. A little bit ironic because vinyls, of course, are not inorganic, but they fit very well with chloralkali. So that is my background. And this morning, I'm going to bring you a vinyls market update.
Oh, girl.
The last time I joined this group for a look at the vinyls market, we were all enjoying the beautiful desert views and lovely weather in Palm Springs. What a difference 5 months in a global pandemic makes. At that time, I characterized the market as facing a potential black swan event. Indeed, the swan landed. So today, I'll be sharing with you our view of the current status of and the near-term market for the vinyls market. I've split my discussion, like last time, into two parts. First, I'll provide you with an update on the IHS market economic and energy outlook, and then we'll turn to the vinyls market outlook. So let's kick the discussion off with some words about the underlying economic and energy market conditions. IHS Markit projects that world real GDP will contract by 5.1% in 2020, which is a huge amount. In fact, that is the largest GDP contraction since 1946. And it's all, quite frankly, a result of the COVID-19 pandemic. Globally, the economic contraction this year will essentially wipe out all of the growth globally for the past 2 years. With respect to chemicals and polymers, the contraction is reversing almost 3 years of production growth. So it's clearly an unprecedented disruption. So what about the US then? If it felt to you and your companies like the economy fell apart in late March and April, you're right. IHS Markit estimates that US real GDP shrank on an annualized basis by a gigantic 15.3% from February to April. A rebound started in May, but to date, only roughly half of the GDP loss has been restored. Recovery is in progress, and technically, the COVID-19 recession will be very short, but the end of the recession in terms of return to positive growth rates does not equate to quick restoration of pre-COVID economic performance. That'll take several years. We'll discuss that outlook shortly. Compounding the recovery, accelerated infection rates in June and July in the US compelled some states to pause or backtrack on reopening. And the virus isn't gone. Consumers and businesses remain cautious. Until that caution is assuaged, we'll experience tempered recovery from both consumer and business spending. Remember, the recession emanated from a consumer spending shock, which translated into sharp declines in investment and trade sectors in 2020. U.S. real GDP, from the IHS Markit perspective, is projected to fall in 2020 by almost 5%, before rising by about 3% in 2021, 4-ish% in 2022, and about 3.3% in 2023. So let's look at a scorecard of global and key country. With the exception of mainland China, all these countries are digging out of deep contraction holes. So as business activity resumes and consumer confidence returns, the strong growth in the upcoming 2 years is needed to restore economies to pre-COVID levels. Overall, we believe that about 2 years of economic growth has been permanently lost due to the COVID pandemic. We're all hoping the worst is over with respect to the pandemic, but with social distancing, face masks, quarantining still required until vaccines are widely available, it's very important to characterize the assumptions behind the forecast that I just showed you. A key assumption is that infection rates are near their peak. The growth numbers we looked at on the last slide would be negatively impacted if a second surge occurs, whether that surge results from collapse of adherence to control practices like masks and social distancing, or a fall resurgence similar to what happens with some other viruses like influenza. That leads us to the associated assumption IHS makes that authorities will be able to control the virus with less stringent lockdowns going forward than those that happened in late March through May. Again, virus rate resurgence that necessitate reimposition of significant lockdowns would set back growth compared to what I showed you as our current prediction. We also assume that effective COVID-19 treatments will be available by the second quarter of 2021, and that there will be an effective vaccine that is widely available around the middle of 2021. Delay in either or both of those would retard economic recovery. On the risk side, we see a host of potentials from more severe pandemic issues to debt crises, all of which have the potential to slow or stagnate growth. Right now, we're currently attaching a 20% probability to one or more of those uncertainties, turning what we believe is a wide V-shaped recovery into a W-shaped recovery. So, because there is downside risk, it's also important to recognize that levers that governments have to address issues are limited now if those downside issues surface. Policy interest rates are near zero in most key economies. That lever is effectively gone. On the bright side, we expect the rates to remain near zero until mid-decade, which does provide growth incentives, especially for markets like the construction market, which supports PVC. Okay, a few quick words about energy. When I saw you all in March, I talked about the massive oil demand shock caused by the pandemic. I remind you that IHS Markit projects that world oil demand will be 11 million barrels per day lower this year on average than last year. That was skewed to the first half of the year. Demand is recovering now and supply's been reduced. So the global oil market has shifted from a supply surplus in the first half of 2020 to a supply deficit in the second half. That shift explains why crude oil prices have more than doubled from April's low. But we project that further price gains will be tempered by a 1 billion barrel inventory overhang and by the OPEC Plus group's plans to gradually raise output in the months ahead. Saudi Arabia and Russia will account for most of the supply increase, which comes just as mainland China's buying spree will subside. So how does that translate to an oil price outlook? Well, we forecast that the price of dated Brent will average $44 a barrel in the second half of 2020, $49 a barrel for the year 2021, which is still a modest oil price, and $57 a barrel in 2022, a slow but steady rise consistent with our expectation of increased economic activity. Because we're here to talk about vinyls, it's important also to look at the outlook for ethylene. In March, I talked about the plunge in Northeast Asian and European ethylene prices earlier this year as lower naphtha prices and lower demand aligned. I told you then that we expected ethylene prices to recover as economic activity recovered, lifting oil demand and oil prices. Indeed, that's what's happened. And while the numbers are slightly different than we expected back in March, the trends are the same. And as I pointed out then, the new normal of relative ethylene prices in the big three production regions reflects a bit slimmer U.S. Gulf Coast low-cost advantage than what we saw before about the middle of 2019. I'll ask you to kind of keep this chart in your mind as we talk about the vinyls market, because it does impact our outlook for the vinyls market. So with that, let's turn to the vinyls market. Like many chemical and polymer markets, the first half of this year has been a stormy one for the vinyls markets. Despite justifiably optimistic market sentiment in January due to improved construction trends, the market turned quickly by early March when the crude oil prices rocked the U.S. economy and the competitive landscape for U.S. PVC. Since late March, COVID-19 related lockdowns constrained residential construction activity, which slowed down PVC domestic demand. By mid-May, domestic demand had fallen by 4% versus the first 5 months of last year, quite the opposite of what our expectations were when this year opened. And both domestic and export prices experienced significant volatility. In fact, the data for the first half of the year show the dramatic impact of the pandemic, particularly in April. April 2020, which is normally the start of the US and Canadian construction season, will go down on record as the worst April PVC domestic demand month in the last 10 years. May demand was also quite weak, coming in 17% below May of 2019. But the domestic demand recovery has been swift, with strong June demand making up much of the plunge in April and growth extending into July, albeit at a much more moderate pace. It wasn't just weak domestic demand either. PVC export data also show a changing landscape versus prior years. Export volumes were under the 5-year range in both March and April. April alone was down 14% compared to March and 27% below the average of the past 5 years. But export volume recovered in May as very low prices attracted buyers to the market. As prices bottomed out, buyers started to replenish inventories. While the strong recovery of May and June has tempered, exports are still well above April rates. Let's take a quick look back at 2019 for a point of comparison for 2020. Despite weak PVC demand in the domestic market last year, the export market acted like a relief valve for producers, with stable export growth of about 1.5%, and average operating rates for the domestic industry of 87%. But in 2020, the double impact from the crude oil crisis and the COVID-19 pandemic has affected both domestic and export markets as was evident in the two slides that we just looked at prior to this one. So what do we expect in the near future? Higher operating rates will come back once the shale gas advantage for North America expands. But 2020 average operating rates are nevertheless forecast to be only 75, maybe 76%, more than 10% below last year. Rapid response data that IHS gets indicate that builder confidence is improving, and in part because of buyers looking for bargains while interest rates are at record lows. And buyers that aren't confident enough to look for a new build are demonstrating improved confidence through DIY activity. So we continue to forecast modest domestic demand improvement through the second half of 2020 and a more gradual recovery in 2021. We'll still, however, not reach 2019 demand levels until the end of next year. We anticipate 2021 to show a more regular demand pattern than we've seen this year, with operating rates for the year averaging around 80%, in part impacted by new capacity that's scheduled to come on stream in first quarter, Shintech's new capacity, in fourth quarter, Formosa's new capacity. PVC is so tied to the construction industry for both new construction and remodel and renovation projects that I want to share some data that characterizes the construction market trends. U.S. housing starts growth trend line was broken in July of 2018. Then the trend line started to recover positive momentum again, but it broke again in April 2020. The U.S. housing starts data show that starts dropped to about 1 million housing starts in 2020 so far from our previous estimate, our previous projection of 1.2 to 1.3 million starts because of the pandemic and the associated economic recession in this country. But mortgage rates are providing some momentum to restart the positive trend line. However, there are some challenges to the potential lift, including shortage of available lots, consumer apprehension, high unemployment, and more recently, evictions. So it's a mixed set of signals that leaves us cautious about the immediate future of construction recovery. The uncertainty of how the COVID-19 pandemic unfolds is keeping the horizon a little bit cloudy. Regarding price development and economics, North American PVC producers benefited from lower cash costs through most of 2019 and the first half of 2020 if we compare them to previous years. Now, I'll ask you to remember that ethylene price outlook slide I showed you at the end of my economic and energy comments. That slide showed our projected upswing in ethylene prices in 2021, which we base on an expectation of higher ethane prices due to lower associated gas production. The ethylene price increase that we forecast will likely put upward pressure on PVC prices. However, new capacity that I mentioned that is scheduled to come on stream next year may dilute or offset the ethylene price effect to some degree, in which case ethylene price increases would translate to skinnier producer margins. The demand factor with respect to price suggests upward momentum also. IHS Markit does forecast improved domestic PVC demand next year to the tune of about 3% increase coming from the low recovery base. However, some price volatility could still be present in the marketplace. One last word about prices and trade. The comparison of PVC export prices from the U.S. Gulf Coast and North American domestic contract netbacks is a relevant point in a market update as the gap between domestic and export in our near-term forecast period. So why do we forecast this spread widening? Improved competitiveness in the global market is expected to translate to some trade headwinds for North American producers. Recall again the relative regional ethylene price forecasts I showed you. While the U.S. Gulf Coast cost advantage is intact, it's a bit slimmer in the near term than before mid-2019. European producers particularly are enjoying a much better cost position than they did before COVID-19. So in the offshore market, because PVC is a commodity, U.S. producers will need to compete via price in order to defend their share of the export market. I'll wrap this up with an updated look at the balance of strong and weak market factors that I shared with you in March. In the second half of this year, weak market factors remain significant enough to temper strong market factors. So we characterize the second half of 2020 expectations as cautious optimism, improving slowly, some bright sides on the horizon, but there should temper our optimism. Barring unexpected economic, pandemic, or geopolitical issues, we see continued slow market improvement and stabilization. I remind you, though, that while consumer confidence and market sentiment have improved significantly since April, there are still many unemployed and underemployed people as a result of the pandemic, and the pandemic itself is still with us. There are no guarantees, and the risks remain. I also want to stress the pandemic will have lasting impact. Acknowledges that the world has permanently lost about 2 years of GDP growth, and that full recovery will take many years with some hangover impacts and paradigm shifts apparent into the middle of this decade. So we look forward to economic improvements while recognizing risks. I thank you for your time today and for the opportunity again to share the IHS market outlook for the PVC market, and I'd be happy to answer any questions.
Any questions for Hazel?
Not seeing any through the chat.
Okay, thank you, Hazel. Appreciate you being with us today. Great information. Stay safe down there.
Yeah,
well,
thank you,
It is
Hazel.
my pleasure, and I hope next time I talk to you all to be able to give an even brighter picture of this market.
Thank you.
And in person. Hey,
person.
Hey, Mark.
And in person, yes.
Hey, Mark, this is Hank Giovanelli. I just had one quick question for Hazel. I was trying to get my thing off the mute.
Sure.
Been able to do that. So what I was asked Hazel was hurricane market over the next month or two.
That's a really good question. There was quite a bit of capacity shut in. I literally came over to this meeting from a hurricane meeting. Unfortunately, I wasn't able to stay for the whole meeting, but what I can tell you is that damage was not as bad as some had expected. We do think that some of the refining capacity is going to be out for an extended period of time. Happily, at least one olefins plant reported this morning that they are getting ready to restart. So there are going to be some impacts. I'll be able to tell you that a lot better a week from now than right now, because we're
Sure.
in a damage assessment stage. But I was really significantly encouraged by the fact that there is an olefins plant that is starting up today, starting the process to start up today.
And I have a second question. When you talked about PVC operating rates this year, 74 to 75%, have you calculated in the shutdowns, but whether planned or unplanned, that have happened in the PVC industry, and how does that affect the overall capacity utilization? Also
a really good question. When we share capacity utilization numbers, our estimates of about 76 or so % this year, we do include outages. So our capacity utilization numbers are effectively the production versus the capacity, installed capacity. So that does include shutdowns. It includes planned and unplanned shutdowns.
I know, but when people look at that number, and talking from the customer's perspective, they look at that number and they say, you have X amount of capacity available, whether you're running flat out at 90% or 91 or 92%. I don't think that's the case with these older plants moving forward. The shutdowns are longer, the outages take more time, and the effective capacity to be in a sold-out situation is significantly below what we used to look at 91 or 92% being effectively sold out. I don't hear anything in the marketplace about that.
Sure. And that's why on that particular slide, what I was really stressing was not the absolute 76% value, but rather the difference in expected operating rate this year versus last year, where our projected operating rates this year are about 11% lower than the average operating rates last year. I think that your point is very well made. You can't look at the absolute value of an operating rate, last year 87%, and say, oh my gosh, there's plenty of excess capacity. It's our assessment of the market that when operating rates start to push up against those high 80s, start to approach that 90% rate, you really are getting to the practical capacity limits of the overall system. Maybe not necessarily a single plant, but the overall system. So the real message is operating rates are significantly lower this year than last. And then the second message was we do expect them to be higher next year, but still to be about 9% below where we saw them last year.
Right. My only point is I think practical capacity needs to be adjusted lower given the equipment that we're all running. But that's obviously very subjective.
Yeah, and it's very difficult to do because practical capacities, as you very well point out, are quite different between plants for a number of reasons. Some of it is are you limited? Do you have a lot of EDC capacity, but you're limited by what you can do in VCM? Are you limited by feedstock supply? Is it a very old plant? Practical capacities differ significantly between plants.
Product line also has a lot to do with it too.
Product line has a lot to do with it. Very, very true.
Okay, thank you. I really appreciated your insight. I thought you did a great job last year, and even in this market, it's tough to deal with. But I appreciate your insight.
Well, thank you. It changes every day. So I would, on that note, mention that we're happy to get emails, to take calls. We do have a major conference coming up. It will all be virtual this year, so no travel is involved. People's travel budget looks like that. But we have a fantastic lineup. The conference will be the 6th through the 9th of October. Please get in touch with me if you'd like more information. The purpose of putting this really extended conference together at that time, we recognize that companies are going into their strategic planning cycles, and it's time to look at how has the COVID pandemic changed the world, and what does it do for strategic planning going forward? So the conference is the day after tomorrow, strategic planning for a post-COVID world.